Welcome to Markets Now. I'm Michelle Rook with Kent Beadle with Paradigm Futures, and we see a lot of red on the board this morning, Kent. And I know we have a lot of economic news that we're going to be sorting through this week. The Fed announcement is coming up here in terms of what they're going to do with interest rates. We also had another bank failure, Frist Republic Bank, over the weekend. And so, how are the outside markets acting in result of that, and how is that spilling over into the commodities sector?
Well, as we speak, we're in the midst of turning a lower NASDAQ higher, and we're rallying the equity markets in the Dow and the S&P. So it appears that at first blush, the marketplace likes the way that the bank situation resolved itself with an industry-based fund actually essentially paying for the bailout of that bank, or the portion of the assets that JP Morgan is not going to take. So I think I think the market is breathing a bit of a sigh of relief. There probably will be more of this, or potentially could be more of this, because there are not. There's usually, when you have these situations, there's not just one cockroach, so to speak.
Yeah.
There can be other issues that will develop, but market seems fairly comfortable with it. Of course, we are going to have the Fed this week as well. We have a very high probability of a quarter point increase. The market, I think, is comfortable with a quarter point increase. Of course, the way the futures market is structured, you're actually pricing in lower interest rates by the end of the year. That's what's going to be a little bit more interesting. And I think the price action post-Fed announcement is going to be keyed toward the tone of Fed Chairman Powell's comments in the press conference. And he has been very consistent in reiterating the fact that we may need higher interest rates. We may need higher interest rates for longer. But you have a lot of data points in the economy that have been turning a little bit weaker. So they're going to want to see how he reacts to that, and if he's still higher and higher for longer, or if he's going to acknowledge some of the weakness in the economy and give us the potential for maybe that interest rate hike that the market has priced in later in the year.
Yeah, it was a tough week in the grains last week. Funds liquidated for several days, and we certainly got evidence of that in the Commitment of Traders report. Do you think they're done liquidating, especially now that you've got funds actually, I think, short in the corn market?
Yeah, well, the funds are short in the corn market, but what's always interesting, we like to talk about the net number, but the net number is made up of longs and shorts. There are a lot more shorts than longs, but what we did last 7 days is to liquidate out the long portion. There was already a short component, and if you looked at the old CIT supplemental Commitment of Traders report, the funds were still net short going into that whole liquidation phase, but there were significant longs in the market that got forced out last week.
Right.
We saw open interest decline 112,000 contracts over those 7 sessions, and you saw the net position move 50 to 70,000 contracts over that time. So it's very, very little doubt that that a lot of this was spec liquidation. As far as will there be more? Well, the funds certainly could get shorter if they choose to, but this is it's still a tight situation. Now, on this break, we took the inverse between May and July corn to over 50 cents a bushel. Average U.S. basis levels are still somewhere in the neighborhood of 35 over the July. So we're tight. We have strong basis levels. I'm not sure that it makes a lot of sense for us for the flat price to move a whole lot lower than it has. And I just wouldn't be surprised if we ended up ultimately getting some sort of a rebound. The biggest drag on the corn market is going to be progress and the fact that we have an open forecast, and that's what's going to keep the bears happy for the time being.
Yeah, and speaking of the other factor that's dragged down the corn market has been this lower wheat market. We're making more new contract lows here, and I think that there's ideas that we are going to see a little bit better winter wheat conditions here and the report this afternoon, and then you also have a little bit better weather for maybe spring wheat planting.
Oh, well, yeah. Starting with the latter part of that question first, it's been such a difficult year to get spring wheat planted, but we are going to have open weather in the Dakotas. It is going to warm up, and I think that you're going to see a fairly sizable amount of progress here now take place, starting very soon, probably by the end of this week, and then in through the 15th, 20th of May. It looks fairly open, and we're going to get an awful lot planted. As far as the conditions on the report tonight, that's really what's going to be interesting, because some of the rain fell on some of the acres that were already rated a little bit better, and some of the areas that were missed were in some of the areas that the conditions were an awful lot poorer. The totals in the Texas and Oklahoma Panhandle were a little bit more variable, and more than likely there's still going to be a chunk of hard red wheat that is in that poor to very poor category. So it's just going to be a question of whether or not the USDA sees, a 3%, a 5%, a 10% increase in good to excellent conditions. That's what the market's going to focus on as we try to figure out what this means for yield going forward.
Right. Well, those are the big headlines for this week anyways. What about this cattle market? We managed to have higher weekly closes, and we shook off a lot of bearish news last week, including lower cash trade. We're a little lower this morning, but do you think we'll be pretty well supported?
Well, I think breaks are going to be supported because the underlying fundamentals are still, historically very, very strong, and we're probably going to see strong cash all the way through the end of the year. However, seasonally, May and June tend to be a bit of a softer month. You see that with higher than $170 cash, you still have $164, $165 June futures price, and so essentially the marketplace has always been pricing in some weaker cash trade that's going to essentially start to develop, and that happened last week. So we shouldn't be surprised. Cash cattle prices and the cutout as well likely to start to move a little bit lower here eventually. But there's a strong underlying supportive factor with just much smaller numbers that we think are going to play through, all the way to the end of this calendar year.
Yeah. And hogs had an up week by about $5.50 in the June contract. Do you think that's a confirmation of a bottom? And, will it be more of a methodical increase in prices here just because we have the futures at such a big premium to the index yet?
So I think it's going to be very choppy. First of all, you had a record short in the hog complex, and
right.
It's not surprising that once you get some inkling of cash strength that you're going to get some of those speculative shorts to move fairly quickly to the exits. And I think we started to see that at the end of last week. And that's what gave us our strength. But it's going to be hard for us to build significantly on that until we start to see the cash markets actually move better than they have. And the projection was 20 cents higher on Friday. We need to start seeing those markets move 50, 70, $1 higher in order for this, for a $95 type June futures price to be attainable.
All right. Well, always a pleasure. Thanks for joining us. Kent Beadle with Paradigm Futures, and that is Markets Now.